Crypto Hotep here with another investing video. We're on week 55 of the Family Portfolio and Dividends Tracker. Now, if you're unfamiliar with the concept of these videos, feel free to go to my channel, go to week number 1, and that's where I break down the methodology, why we're doing this, and my whole entire process. So basically, to give you a quick synopsis, what I did was I gave my family a list of stocks, some well-known companies they could choose from. They chose the companies based on how they felt about them, what they knew about them, and then we proceeded to use M1 Finance as our broker of choice, because with M1 Finance you can have a big portfolio and then have sub-portfolios in it. So every one of my family members has a sub-portfolio with his or her own stocks that they're choosing, and then every week we go through this portfolio. We go through balances, dividend activity, which is my favorite, and just how we're feeling about the markets and any big news that's happening. These videos are not financial advice at all, but if you like them, feel free to like, subscribe, comment, let me know what you think. Let me know what you don't like. Just let me know what we could be doing better, if anything. So with that being said, we can jump right in. But before we go to week 55, we go to week 54. Week 54 saw us actually achieve a balance of over $2,000 in this account. Now, again, if you've been following the channel from week number 1, we started this portfolio in February of last year with just a little bit of money. And as you can see, we have increased this balance over $2,000 as of week 54. And we had the portfolio was in the red though, so it's down over 6%. Market gain of a negative 121, and then dividends earned of $6. Now, what's been going on as of late, if you've been living under a rock, is one word, and that is tariffs. So Donald Trump unveiled a new tariff plan. The reciprocal tariffs is what he calls it, for over 100 countries, and he did that this week. The markets did not like that necessarily, and the markets have been in a free fall, with reaching lows that we have yet seen since 2020. So with that being said, we will look at what the balance is. So not that bad, but we are down below 2,000 again. So 1984.15 is the balance. Money weighted rate of return still in the negative, of course, negative 7.84%. Market gain of a negative $154.06, with $6.28 dividends earned. Okay, so again, when in doubt, zoom out. If you want to see where we were at this time last year, that's how far we've come. Okay, that's how far we've come. Very good trajectory, I will say. But let's go to, before we go into the portfolio, let's go to the activity, and let's see what the activity we had going on between this week and last week. So between this week and last week, we did have a little bit of dividend activity here. So we have 4 cents from Broadcom. Pepsi paid 43 cents. That was a big payout for my wife there. Union Pacific, 5 cents. Coca-Cola, the GOAT, 16 cents. And then Texas Roadhouse had 3 cents. We even bought, we had a little cash lying around, and so I added to O, Realty Income. Now let's look at our portfolios here, because I did catch something that I think we will have to adjust. So bottom to top, we'll go to my wife's. Unfortunately, she's at the bottom, but year to date, she's actually the only one in the green. So in the green currently, up only 0.11%, but up in the green here, and she has a massive portfolio with Celsius. Now, if you have followed this channel from week number 1, one of the top holdings in my wife's portfolio was Celsius from the beginning. And Celsius was on a trajectory around the springtime in 2024. And my wife benefited greatly from that. But she also benefited greatly from the downside of Celsius. And it took her portfolio deep down in the red. But as you can see, we are trekking back and looking pretty good with Celsius right now, up over a staggering 42% year to date on Celsius holdings currently. Very, very good. Average share price was around $39.21. So can't really beat that right now. Okay. Pepsi, we are up over 1.25%. Tesla, still bleeding out on Tesla, and Google, still bleeding out on Google. But I will say this, Google and Tesla are fantastic buys right now. Let's go to our middle stock. In our middle stock, we are down year to date, negative 13.65%. Market gain of negative 27.07%. 60 cents dividends earned with a full balance of $202.95. One thing that our middle did choose to add was Google. Our middle did choose to add Google, and main reason behind that is, quote unquote, well, everybody uses Google every day. It seems pretty good. Simple enough, we can add Google. So, when we throw in a little bit of money potentially next week into the portfolio, we'll probably be buying a little Google in our middle stock here. So just a nice collection of stocks here. Target has been really falling off the cliff here, as you can see, down over 33% in Target. Amazon, again, following the tech stocks, down over 21%, and then Tesla as well. Nintendo up over 13%, but this is one thing that I did notice when I clicked into Nintendo. So Nintendo, for our middle and our youngest, because if you've been following the channel, you know that our middle and youngest hold Nintendo. Apparently, this asset or this holding is in liquidation only mode and can only be sold. So no new purchases can be made on Nintendo. So I will have to talk with my middle and youngest and see what we want to do there. Okay. And I think that's because Nintendo is not necessarily traded on the New York Stock Exchange. It's only traded on Tokyo's Stock Exchange. So a little bit of a bummer here because we may have to liquidate Nintendo and put it into something else. But that's what happens when you deal with stocks, and those are some of the conversations you have to have. Let's go to our youngest. Our youngest, again, money weighted rate of return of a negative 8.86%, market gain of a negative $20.29, and then dividends earned of 33 cents, balance of $243.52. Unfortunately, Nintendo is up again. We will have to talk about that, see what we're going to do there. But then everything else is down. Our youngest did want to add Costco. So our youngest did not have Costco, wanted to add Costco into the mix here. Very safe choice, very good choice. I'm not mad at that at all. But the tech stocks, along with Starbucks, down considerably during this kind of bloodbath, if you will. And then my stocks down over 4% year to date, market gain of a negative $29.12, dividends earned of $3.52, with my balance sitting at $650.61. Tech stock obviously bleeding the most, down a staggering almost 22% here. But I will say this, some shedding our light onto a couple things. And it's funny when we get into different markets, or different market cycles, I should say. I mentioned this before. Again, I like to point this out. Industrials and energy is holding its weight considerably. Duke Energy, Waste Management doing numbers right now. Exxon, Chevron, Cintas, Deere & Company, Caterpillar is down considerably, not too worried though, and Union Pacific is down a little bit, but majority of the team is holding strong here. And if you know that if we are going into that R word, if we are going into a recession as an economy, a forced recession, if you will, then you're going to see some defensive stocks kind of holding their weight. And what I mean is, some of the defensive stocks that I have are the consumer and staples and shopping. So the very like boring stocks. Why? Um, because people will have to consecutively or consistently, excuse me, buy things from these companies. These aren't going out of style at all. We have Costco. Costco is doing numbers. Kroger just hit a new all-time high today. Colgate, I mean, everybody's still brushing their teeth, washing their hands. Kraft Heinz up over 1%. So these very boring companies and also dividend companies will kick into high gear as the recession fears start to loom here. Now, another one of my sectors that really caught my eye though was the restaurant and food industry. We're up over 8% year to date on restaurant and food. Coca-Cola up over 18% with Coca-Cola. And we're finally in the green with Hershey. Hershey, we're positive. This has been red for a long time. We're positive now. McDonald's up over 10% of McDonald's. Why? McDonald's offers cheap food. People will definitely be looking at their costs coming up if they aren't already, and they more than likely will be going and being viable for the cheaper options for food. Same thing with Domino's, same thing with Smucker's here. Starbucks on the little higher end, and they're a little bit red right now, but Texas Roadhouse, I'm really not worried about Texas Roadhouse. Texas Roadhouse is a fantastic company, is holding their own. And then pharmaceuticals up as well. So, with that being said, the portfolio I have is not too bad, and especially everything considering with how bad the market dropped, I'm not mad at this at all. And then last but not least, let's go to our Otis. Our Otis down over negative 11% year to date. Market gain of a negative $77.28. Dividends earned of $1.37, and then down now under $700 at $694.07. Just the standard four that we've had from the beginning of this tracking: Apple, McDonald's, Costco, Tesla. Tesla holding the kind of the brunt of the portfolio down over 32%, and then Apple at a significant discount right now. But again, like we said, McDonald's, Costco, we kind of look at these as kind of defensive stocks that you can kind of hedge your bets against here, just because they're on the safer side. Again, stocks, there are some risks with stocks, but again, there are safer stocks than most. So, and with that being said, guys, we will switch over from the family portfolio, and I just want to do a quick deep dive here on Google, because I think Google, for the most part, I believe Google is a very undervalued, if we can say that about Google, and very cheap stock right now. If you look year to date, 20% down, negative 20% on Google year to date. Yearly down over 2.5%, almost 2.5%. But as we keep going across the time frame, you can see where we're at with Google. But that's not the main reason why. So Google is sitting at $150.72 per share. The forecast, the quote unquote analysts, are calling for an upside of over 40%, up to over $200, and the analyst consensus is to buy. Well, why is that? The reason is because Alphabet or Google, despite their drop in share price, the fundamentals of Google are still strong, meaning that revenue is still up and climbing, gross profit is still up and climbing, and their cash flow is still up and climbing. And one of the things I do look at is net income. So, very quickly, with that being said, I think Google for right now is a very good stock to bring into your portfolio. And as always, guys, if these videos help, feel free to like, subscribe, comment, and let me know what you think. And as always, thank you and happy investing.